Earlier in our broadcast, we talked to Congressman Scott Garrett about Republican plans for the future of Fannie Mae and Freddie Mac. Here's what he had to say.
With regard to the GSEs, Fannie and Freddie, our goal is to, just what the administration says, is to wind them down and to move that whole marketplace that was over here in the GSEs and move it into the private marketplace.
Joining us now with his reaction is Michael Berman, chairman of the Mortgage Bankers Association. He testified this morning before the Senate Banking Committee about how to reform housing finance, including Fannie and Freddie. And he's also, by the way, the CEO of CDOs-Capital. That's a national lender for multifamily and commercial real estate. Michael, good to have you here with Matt and myself. So what do you have to say in terms of what Representative Garrett had to say about winding them down, moving it from the public to the private sector, Fannie and Freddie specifically?
Well, there's no question that the government footprint is much too large, and there needs to be a movement towards the private sector with private capital as the predominant source of funding for the housing markets. Having said that, we need to be very careful and approach this in a measured fashion, since the stakes which we have here are quite large. We all know that the housing recovery is just in the nascent stage, and it's quite fragile. And so while we do have an end game of wanting to get the GSEs out of the business, the bigger question is, what should the government role be, and what should that end state look like, and then getting there through a very gradual transition.
Well, what should the government's role? Are you saying that the government should have a role when all is said and done and all the winding down is done, that the government should still have a place here?
Yes. In our view, the only system that would allow us to have liquidity throughout all times of the economic cycle, particularly in times of economic stress, such as we've just seen in the last 3 years, would be to have an explicit but limited government role. The concept is we need to bring private capital in to take both interest rate risk and credit risk, but we need a government wrap. We need an explicit but limited government wrap around mortgage-backed securities, so that even during times of stress, when there's less confidence in the market, bond investors will still be there to bring liquidity to homeowners and multifamily owners.
But why? So many other developed nations around the world don't have an explicit government role in this market. I mean, how about when there's no liquidity, there's just no liquidity? That's just the way the market goes, right?
Capitalism?
Sure. Well, we've certainly seen what would have happened had Fannie and Freddie and FHA not been in existence over the last 3 years, which is there would be virtually no liquidity in any of the markets. I don't think that politically this country has the tolerance for that kind of volatility and instability. We've seen a quite dramatic crash in real estate values, both commercial as well as residential, and our ability to come out of that is very much tied to having liquidity and financing. Just as a very simple example, if somebody's looking to get a new job and they need to move to another location, to another city or another state, and they can't sell their house because there's no financing available, it creates a gridlock, and it doesn't allow the flow of commerce and doesn't allow the economy to function as we really need it to.
Don't you think, though, Michael, that that American voters are starting to ask the question, why should I, as a taxpayer, subsidize my neighbor's mortgage, my neighbor's right to own a house, especially when so many people are renters who can't afford to get to that level? I mean, why should individual taxpayers in this country subsidize the housing market?
Well, I think there's two different issues. The first question really is whether and to what extent we can have liquidity without any government role. And the MBA is certainly in favor of promoting as large of a private sector role as possible. But when you get to the issue of subsidizing, it really begs the question of whether the taxpayers will be, in fact, protected, or whether they'll be taking significant risk when there is a government role. What we've tried to do at the MBA is structure a government role that's limited and has a number of taxpayer protections. In the first instance, for instance, we would have a defined set of core mortgage products, not unlike the qualified residential mortgage definitions that we saw today coming out of the regulators, where they would not be risky mortgages. So, for instance, subprime and Alt-A loans, where much of the problems have taken place, would not be eligible for any of this government subsidy or the government wrap that I've described. Furthermore, we would have a strong regulator, we'd have adequate capitalization, and we'd have an alignment of interest such that private capital would take the first risk. And so if we have those protections in place, I think that the subsidy would be very minimal.
All right. Hey, Michael, thanks so much for joining us. Michael Berman there, chairman of the Mortgage Bankers Association.